Good morning, everybody. I'm Nwabisa. I'm the mortgage advisor here at Ascot Wealth Management. I've probably been at this job about 2.5 to 3 years now. It's been an experience. Mark?
Hi everyone. Mark Inslee, director and founder of Ascot Wealth. Thought it was still worth value jumping on this particular webinar, as much as Nwabisa is fully in control of all the cases that are still sort of going through the business, with so much going on in the interest rate space and market. Certainly thought it was worth inputting views from an investment side. Can also chip in a little bit on the advisory side, but hopefully that will sort of give us a straight rates insight from Nwabisa, as well as a bit more outlook from myself.
Just a quick disclaimer, this presentation is for information purposes only and doesn't constitute any financial advice. You would be required to speak to a financial advisor before sort of making any investment decisions going forward. And then just a bit of our business expertise, first-time buyer mortgages, new residential purchases, buy-to-lets, let-to-buys, development finance and building finance. Those are all things that we can assist you with. And let's just get in touch if there was anything specific that you wanted to discuss.
And where would you say at the minute the most of your business is focused, Nwabisa?
Probably in the remortgage residential mortgage side, and then also obviously there's lots of business in terms of buy-to-lets because many clients do have investment properties, but we do see the sort of odd cases on the other side. Okay, so this webinar structure, we're going to look at the interest rate market just because obviously it's probably the most talked about, or at least at everybody's forefront or on everybody's mind. We'll be looking a little bit on the buy-to-let market, later life lending, and then house prices. So in terms of interest rates, as I said, it's probably one of the most talked about topics right now, due to mostly the activity in the market since sort of February or up to February 2023. The Bank of England has sort of announced consecutive increases in the base rate, which have taken us to about 4% right now. This is mainly due to sort of monetary policy trying to control or at least get back control of inflation, which has been persistent throughout the market. Today we are expecting another announcement to be coming from the Monetary Policy Committee. They're actually meeting at 12 o'clock. I somehow always end up having a webinar on the same day. So basically, the sort of market thought is that there probably will be another increase to about 4.25%. But again, this is sort of having to be balanced because there's a lot of other market factors that the Bank of England needs to sort of consider, which one of the emergence that's been happening in the last couple of weeks is of a potential banking crisis and this instability in the banking systems. We've seen that with the Silicon Valley Bank in the US, and then also Credit Suisse bailout by the UBS just, I think, last week it was. So there's a lot of factors that are still in the balance that they are still considering in any sort of announcement that they will continue to make. But obviously that does affect the overall interest rate market. And so we are closely assessing or closely looking to see what can be expected or what announcements there will be made, because again, they will have direct implications to sort of everyday people.
And I think, yeah, if you're someone in a mortgage cycle coming up, or someone that's going through with a purchase, I think a bit like sometimes trying to pick the bottom of the market. Perhaps it's going to be very hard to get there. Not getting a rate on a day, because we think rates are going to pivot towards the end of the year, early next year. But I think that if we take the last 2 weeks into account, as much as I do think that rates will go up today, I kind of hope they will go up today, because inflation certainly hasn't got down anywhere near to the levels. So those inflationary those interest rate increases are definitely needed to show further progress on that. But yeah, it's been a scary few weekends with the Silicon Valley and Credit Suisse. But what that's actually done for bond markets has actually been to bring bond yields down. So bond yields react based on everyday market events, and the 2-year US Treasury and the 2-year and 10-year gilt are certainly 10% lower in terms of market pricing terms than they were. So today's an interesting day, where yesterday the Federal Reserve raised interest rates. I think the Bank of England will follow through. So rates are rising at a time bond yields are actually going down. So I think what the conclusion of that for the mortgage market is, as much as rates will go up today, I think there can be some forms of comfort for those coming into purchases, that we don't see rates going too much higher. The panic rates, we've already had a period where mortgage rates have been higher. I think Nwabisa had a week where we're more in the 5% and stuff for fixed rates. That was more to do with the liquidity crisis in the in the English banking system. I think just before Christmas. That's kind of a little bit of a similar similar situation in the US. So, and again, I don't want to talk too much about the US in a UK mortgage rate presentation, but I think some of these systematic system-based events are similar to stuff that we saw in the 08-09 Lehman's crisis. So as much as on the portfolio management side, we're asking clients to exert that bit of patience. These feel things that happen very sort of like late towards the end of a cycle, and rates have already had to respond to what's been a very tough year and a half going through so many different geopolitical to unexpected black swans like COVID, to dealing with 80s level inflation. So yeah, as much as there's not a crystal ball, we naturally, I think, see a split between discount rates and fixed rates at the minute. Fixed rates are fixed rates. They give you what you want for the set period of time. And again, whether it's at today's levels, whether we can get fixed rates 1% lower in a year and a half's time, it's a factor in buying an investment property, but and keeping a residential mortgage. But properties are very, very long-term investments as well. So as long as borrowing is kind of within target and within affordability, these factors are important. We want to get clients onto the best rate we will always do that. But yeah, we think we are still towards the peak.
Yeah, as we said.
Sorry, I've kind of just explained that whole slide there.
I think you've actually explained the last 2 slides, because you've sort of touched again on the last 23 years now. And here I show the average UK rates. Obviously, we're at that peak that's about just below that 6% mark. Which we haven't seen since about 2008, sort of going past that 6% average. But yeah, I think where we are is that we are probably more towards a recovery in the longer term, probably in the next 1 to 2 years. But we will probably see that these rates will start to lower down to that 4% mark. In the next slide, I'll show sort of where the current rates are. So we see that on the sort of residential and remortgage, these are only fixed rates, just to clarify. that's now looking at a 2-year fixed of about 4.36% on a 60% LTV. 5-year fixed rates about 3.99% on a 60% LTV. And then we've also added the 7-year and the 10-year fixed rates, which Mark commented on the sort of how good that 10-year fixed rate was in terms of looking at it for as he said, a long-term investment strategy. We also just briefly discussed discount rates, which basically for the residential purchase mortgages are at about 3.8. But again, that gets affected quite a lot by banks and the standard variable rate. And so you'll see a lot more fluctuations in that. But obviously on the fixed rate, it gives you a little bit more certainty as to sort of where you're locked in, what your monthly repayments are, and seeing that sort of stability. Mark, anything else to add there?
No.
Perfect.
I mean, yeah, from an investment perspective, probably the only point to add is that we don't still do a massive amount of business in the, in the 10-year space, but, I as someone that, would be advising clients to obviously be buying buying an investment property is still part of our asset allocation process for clients. And again, anyone buying a property shouldn't be buying it really for sub 10 years. So, I always find the longer parts of these curves interesting from a buyer and someone advising clients to go into that much longer term view of property. I see the 2-year rates dropping, 5-year a little bit, 10-year I don't think sort of gonna change too much from there. So again, this is where the debates and conversations with a broker like Nwabisa is like very, very interesting, because yeah, it's not like it was 3 years ago. Let's just put it on a 2-year and roll it and get another good 2-year. The decision making is far more complex and debated, and yeah, that's the value in having the time with her at the important decision making periods.
Yeah, and then that sort of also trickles onto the buy-to-let market, looking at rental yields, buy-to-let rates, and then I've also added sort of a channel regarding buy-to-let portfolios, because I think there's some value there that we can add. Sort of looking at the rental yields or average rental yields on residential estates. This specifically is the third quarter of last year, which again speaks to sort of the returns on investments that are still there and the potential to be had. And then also sort of breaking out in terms of the regions and areas that other clients might not, or clients might not sort of be inclined to look at, but actually the investment opportunities there that can really sort of stimulate your portfolio, or at least make it very much so worthwhile.
Oh, sorry.
Yeah, and then again, sorry, this is just an addition of the rental yields by the regions. As you can see, the Northwest, their average yields of 10.8%. We'll look at property prices a little bit later on, which quite almost seem in conjunction with this. Again, that of the opportunities that are there, because yeah, in terms of the property pricing and then the rental yields that can be derived from there. And then the next slide is going specifically into sort of the lowest fixed rates for buy-to-lets right now. Again, sort of in the same region as the residential purchases, with their 2% or sorry 2-year fixed rates at currently 3.99% on the 60% LTV, and then up to this 10-year where we can see it's about 4.94%, and then again also looking to those clients looking to remortgage. The rates on the side there that you would sort of be looking at on the 2-year fixed rate, 4.36%, 5 years, another 3.99. So again, the view is probably that this is sort of the rates that we can expect throughout this year. My expectation is that the lenders will probably be sort of fighting for market share a little bit. We'll see that maybe drop by like 0.01, 0.2, all of them sort of trying to still be the lowest in the market. The only other thing that I can add there is that also on buy-to-let properties, we've seen quite a lot that the the product fees have increased quite a lot, sort of looking between like a 2% to 3% of property values now. We are still getting some lenders that will sort of base that on like a fixed amount, like the normal 999,000 to about £2,000 to be added onto the product. Most people do still add that onto their mortgage, etc. But yeah, that's just sort of an indication of where the market has gone, and also just the cost of borrowing in general. Then this slide here, I was looking at sort of property reviews, or reviewing your sort of overall financial the debt servicing of your property portfolio, especially or specifically for buy-to-let properties, where a number of clients might have a number of properties in their portfolio. For example, say a client had about 3 properties in their portfolio, of which sort of 2 was at the higher side or higher LTV. And another property maybe in the lower LTV that probably you've had for 15, 10 years, etc., and you've been paying that mortgage down. But actually being able to review your property portfolio and refinance, and that basically means getting more debt out from your lower valued or your lower loan value, to then pay off another mortgage or another property on the side to decrease that LTV. The reason that I say that obviously is because if you look at that LTV at the 85%, that would be about 6.9% or 6.99% in interest, where previously or in the previous slide we just saw that the 60% LTVs are about 3.99, so like almost half. And so that can change sort of the monthly repayments on the interest and servicing that debt, and then also add other like additional value in terms of what you should or what you are currently paying and what you should be paying. And that's something that I like to review with the clients when somebody does have a property portfolio in hand, and they're looking to remortgage, and sort of where that value can be added to the portfolio. Then the slide here is regarding later life lending. I think the reason I wanted to bring this forward or to this webinar was because obviously the older people are also affected in terms of cost of living. There's limited, or their sort of power in terms of purchasing power becomes limited the older that you get, because you're sort of focusing, or how do I say, only dependent on your pension income, etc. So these mortgages as well can help you in terms of being able to refinance your current property. So it doesn't necessarily mean just because you're sort of above 70 that you couldn't get a mortgage. And there are specific mortgages that would actually look at the older people, or specifically designed for older people, such as a retirement interest only mortgage. This one specifically would be where the client would actually be able to take an interest only mortgage, and then have the capital paid back once they went into long-term care or on their debt. And then equity release is another product that Mark loves to sort of speak more in detail about. Mark, could you sort of talk a little bit more on the equity release side and how that plays into IHT planning?
Yeah, sure. I mean, yeah, sort of always a debate over the sort of later life retirement interest, and I think number one for anyone sort of thinking about this. And I think there's a question from Jeff on this. So yeah, we haven't got a wide spread of rates, but happy to get those after. And yeah, generally, if someone can stay on a residential mortgage, right up until age 75 and still be using that as a borrowing facility and things, and then do equity release at that point, I'd say that's definitely the better position to be in. That wasn't my view 2 years ago. We did some great equity lifetime mortgage, because I don't really like the word equity release. It has all the old connotations of home reversion attached to it, which is a space we wouldn't go anywhere close. So absolutely, Jeff, using the word lifetime mortgage is the right terminology there. And yeah, for me, there will become a better time to do this in the next 2 years. As I say, I don't think rates will have a prolonged cycle of being higher. That they're going to be lower. So naturally, there will be another opportunity for clients, I think, to use lifetime mortgages a little bit more in their planning. We did a couple of cases 2 years ago, sub 3%, which I'm still waiting for those clients to give me a pat on the back, but they demonstrated that fixing in for the rest of life on something that was very, very affordable, the release of equity that gave them, some for lifestyle reasons, some for liquidity, some for inheritance tax planning. For me, I think if we could get back to sub 3.5%, then they become more useful for inheritance tax planning. Myself as an advisor, I'm not comfortable using them for inheritance tax planning at 5.7, because it leaves me a very high rate to justify on the other side if it is a straight inheritance tax planning strategy. For clients that need to use it because they haven't got an alternative at 75 to pay a residential mortgage off, then absolutely, there's still a cracking product. You'll pay a little bit of a premium for the rate, but if you don't want to downsize, if you don't want to give up a house, they're still very much a viable alternative. And what I'd say on the lifetime mortgages, again, rates have already come from above 7% at the panic point, where they're just no point looking at rates that high. In my opinion, you're burdening yourself with a 7% debt with infinitive cycle. Sub 6 interesting again. We did a case the other day with Greg, our equity release lifetime mortgage specialist. Sub 6 is part of the discussion again, really. But yeah, we definitely think clients, please bring it up in your meetings. Please debate it with Nwabisa. As I say, generally a mortgage, extending a term and doing it with Nwabisa, using pension funds even as the affordability mechanism is going to get you a better rate. But the later in life things go, inheritance tax planning strategies, lifetime mortgages definitely are something to keep talking to us about.
Thank you. Then sort of the last topic that we wanted to talk about was the UK house prices. We've just sort of seen in January, the year-to-date or 12-month period increase of about 6.3%, and bringing sort of the overall UK average price to about 289,819. Again, really an increase over on a year-to-date basis, but then obviously between the sort of December-January season, there has been a decrease in the market, which was sort of presented by around like a 0.4 decrease in December, which basically can be attributed to sort of the contributor of the December lull, where less people are sort of looking to move in that time or looking to look at new property. But we'll start to see the market stimulate quite a bit as we go into the summer, and sort of see a recovery in terms of the house prices. Again, here's just sort of an overall graph showing the sort of 3-month period increases. We see a bit of a drop there in that December January period, but again, expecting it to sort of increase or restabilize back as we sort of move into the summer period, as you can see, sort of followed by that 2022 graph. Mark, any additional sort of investment from your side in terms of the property market?
I think really just still, this is a short-term graph. We've obviously got lots of other graphs where they're like this. This doesn't particularly upset me. Houses, as I say, are there to be held for a very long time. I just say sellers are conscious that we've hit a period of low months, so those that really wanted to get rid of properties are going to be open for negotiation. Do that. I still have lots of clients that moving from one residential to another. We always put the argument forward that house is still an important part of the wider portfolio. Can you move but keep your existing residence as turn that in? There's a lot of stamp duty to pay in buying a new investment property 3 years later. So that's probably one strategy we've continued to talk to clients about at the point of upsizing a residential. Still consider keeping the older property to save the stamp duty. But no, I think all this has done is taken a little bit of steam out the market, if you like. There's some really good increases outside of London after the COVID period as people moved out and made different lifestyle decisions. So I think in a little way this was needed, and yeah, that just means there's a little bit more negotiation on the table than there was 6 months to a year ago. And that's kind of a reminder of the longer term trend. I sit in lots of economic forums that debate, is this sustainable and are we going to have a flat 10-year? But many of those people are the same people that were saying this back then. So there's not enough houses being built in the UK still, in my opinion. As I say, I don't like seeing clients that have pure property in their portfolios, but there absolutely still is a role for investment properties. That's sort of the longer term trends there of the annual house price changes.
Yeah, and then this again this graph I added to just sort of talk about the regional annual changes. As Mark sort of just touched on there, that again that there were different sides outside of London that started seeing a lot of increase in value over the last year, and that just was a graphical representation of that.
And I think as much as it's easier to manage an investment property sort of close to home, I think certainly with so much continued focus in recent budgets on improving and building economic centres outside of London, I think stats like this already backing up that there's certainly value. I was having a long debate with Katrina around core places like Cambridge, for example, as being if you can run the operations of a property there, I think somewhere that is as knowledge intensive as Cambridge, still leads to naturally more wealth being generated in an area and reasons why property prices in a place like that will go up. They've obviously bagged lots of good gains themselves. This isn't something new, but I'd say sort of that was one area we were discussing for clients' property portfolio expansion. So yeah, definitely value in different parts of the country. So it's definitely not just a buy in the southeast argument, I would have said, for the next sort of 5-year cycle.
This basically is sort of drawing an end to the webinar. I think the key points to sort of take out is that currently we are sort of in a new phase, I would say, of the interest rates, where we've just come out of extreme or really low interest rates. We've seen the Bank of England make radical sort of changes to the base rate in sort of the curve of inflation overall. We've seen how that's affected the current rates, and then the overall market in terms of where rental yields are, house prices are, and really just reiterating that there is still opportunity. We can look at how to make this as affordable to you as possible. I know cost of living is a very sort of imminent or topic that everybody is talking about. But yeah, in terms of the property portfolios, we are happy for you to talk to us. So with that, we can sort of discuss ways that, if we can add value to your overall portfolio. Mark, any last words?
Not last words, but I'll jump straight onto the question from Don there. We would say 3 months is an absolute minimum. Personally, via advisors directly with Nwabisa, I think debates on fixed term strategies should be sort of like 12 months before. I think the more discussion, debate around what are the objectives of that particular mortgage. Again, not straight answer to the question, because it's probably a different answer to a residential mortgage to a investment mortgage. But we would love clients in the 12 months before the end of fixed to be engaged with us. We were running lots of calculators as to whether it was worth coming out of mortgages with penalties and things. That exercise sort of became a bit redundant with the speed that rates were rising. And yeah, as a result, now my view is rates to come down rather than go up from this point. So again, it's just being ready, ready to be making those decisions, allowing enough time. And I think the most important point on that is some of the standard variable rates that clients will go on to are horrible right now, because lots of lenders wrote in 3.5%, 4% above base as their standard variable rate at a time when it was a different business cycle then. It was like people coming to the end of a 5-year cycle where they've done 5 years at 1.7. That's when mortgage companies, weren't making margins on their rates, and as a result, were relying on those inefficient people, but were relying on those people that just rolled onto standard variable rates, not reading the terms and conditions, and suddenly lenders making 7%, 8%. So that's what we just keep stressing to clients is, start that decision early, because don't be one of those people that goes onto standard variable rates, because I think Nwabisa gets that more for new business, people panicking, they didn't realize, and they're now on like a 7% interest rate, and they don't need to be. Some of the easiest business we write, because we can fix that and get them back onto a tracker, and there's an instant saving. But yeah, now more than ever is the time to not roll onto the standard variable rate, is probably my concluding comment.